Imagine this moment. Retirement is no longer a distant idea. It's approaching. And late at night, when the house is quiet and there are no distractions left, the same questions keep returning. Have I saved enough? Did I invest wisely? Will what I've built actually last? Those questions feel heavier today because the financial world feels louder than ever. Tariffs dominate the news cycle. Artificial intelligence is reshaping entire industries. Recession warnings appear and disappear with every economic report. Commentators argue endlessly about U.S. markets versus international markets. And a handful of large technology companies now seem to control the direction of the entire stock market. If you pay attention to financial news at all, it can feel as if everything is urgent. Everything demands action. Every headline suggests that if you don't respond immediately, you'll fall behind or make a costly mistake. And that pressure almost always leads to one central question: what should I actually do with my money? Here is the counterintuitive truth. When the financial environment becomes more chaotic, the most effective response is not to add complexity. It is to reduce it. There exists an investment strategy so simple that it can be explained on a single page. It does not rely on stock picking. It does not depend on forecasts. It does not require constant adjustments or reactions to the news cycle. And despite that simplicity, this approach has quietly outperformed the majority of professional investors over long periods of time. That strategy is known as the three-fund portfolio. The three-fund portfolio is exactly what it sounds like. It is an investment system built using just three broad index funds. The first fund is a total U.S. stock market index fund. This single fund represents ownership in virtually every publicly traded company in the United States. It includes the large familiar names that dominate headlines, but it also includes thousands of smaller companies that rarely receive attention. With one fund, you own them all. The second fund is a total international stock market index fund. This fund holds companies from outside the United States, across both developed and emerging markets. It gives you exposure to businesses operating in Europe, Asia, and other parts of the global economy. Together with the U.S. fund, it ensures that your portfolio is not dependent on the success of a single country. The third fund is a total U.S. bond market index fund. This fund holds thousands of investment-grade bonds, including U.S. Treasuries, high-quality corporate bonds, and mortgage-backed securities. Bonds serve a different purpose than stocks, and their role in the portfolio is both practical and psychological. When you combine these three funds, you own stocks and bonds, domestic and international markets, large companies and small companies. In practical terms, you own the investable world. The power of this approach comes not from what it adds, but from what it removes. You are not trying to predict which stocks will outperform. You are not reacting to headlines or market narratives. You are not attempting to time when to get in or out of the market. Instead, you are accepting a simple reality that many investors struggle to accept. Markets reward ownership and time, not prediction. At the core of the three-fund portfolio are index funds. Index funds do not attempt to beat the market. Their goal is to match it. That distinction matters more than it appears on the surface. The evidence is remarkably consistent. Over long periods of time, the majority of actively managed funds fail to outperform their benchmark indexes. This is not because professional managers are unintelligent or uneducated. It is because higher fees, frequent trading, and poor timing quietly compound against them. Index funds remove that competition entirely. You are no longer trying to outsmart professionals or anticipate market movements. You simply participate in the returns of the market itself. Your primary responsibility becomes staying invested long enough for compounding to work. One of the least discussed advantages of index investing is that it is self-cleansing. Within an index, companies are not permanent. When businesses weaken, shrink, or fail, they naturally lose weight or are removed entirely. When new companies grow, innovate, and succeed, they are added automatically. This process happens without any action from you. There is no need to monitor individual companies, no need to decide when to sell, no need to guess which businesses will matter in the future. The economy evolves, and your portfolio evolves with it, without you touching a thing. The three-fund portfolio also provides global diversification without requiring forecasts. Markets take turns leading. Different countries outperform in different decades. There have been long periods when U.S. markets led the world, and long periods work.